What is different about your product?
You got a story to tell. Something gonna connect to somebody else.
How to actually run a business versus having a vision for a business.
A lot of people come to me and they say they're scared to take that next leap.
Visual design is always going to be driven by the vision.
And I just was like, how do I do this?
What am I adding that they don't have?
Hey, brand builders, ready to take your brand to the next level? I'm Dana Ammons, and welcome to the Brand Blueprint. Welcome back to the Brand Blueprint. I am your host, Dana Ammons, and today I am really excited because we have a great program in store for you. I am happy to welcome Patrice Malloy to the show, also known as the Affluent CFO and the Financial Fairy. Now, why do I have Patrice joining us, especially in the month of January? Well, for founders who are sitting there at your desk in your office thinking about the to-do list for the month of January, one at the top of your list is likely preparing for tax season. And so no better time than to have Patrice join us and address one of those most critical yet often overlooked aspects of running a business. Now, taxes is something that stresses a lot of people out, whether it's your personal taxes or your professional taxes. And Patrice is a master tax strategist with years of experience helping founders and small business owners optimize their financial strategies while building wealth. And that's what's important, people. It's not just about paying the man, but it's also about building some wealth and actually finding ways to save and optimize your finances for tax season every year. So we're going to spend some time talking a little bit about some of those scenarios and getting some advice from Patrice. But first, let's start by welcoming Patrice to the show. Patrice, welcome to the Brand Blueprint.
Thank you. I'm excited to be here, and I appreciate you having me today. I am excited to dive into this topic and give the people what they want.
No, definitely. And so before we jump into it, I do want to do something that we actually make a habit of on the show, and that's getting to know you a little a little bit better personally before we dive into the meat and potatoes of the show. We call this section our rapid fire question and answer segment. So are you ready to jump in?
I'm ready.
All right, great. So let's get started. Now, we designed the rapid fire question and answer segment today specifically for you, Patrice, in light of your tax expertise. I wanted to give you a couple of questions that I thought would really tap into that. So first one is, what is one of the surprising things about taxes that people don't know?
I think that one surprising thing is people figure that they have to only focus on taxes like for January. And the reality is that we should focus throughout the year, whether it be, paying your quarterly estimated taxes, tax planning to make sure that at the end of the year, you don't have unexpected tax bills or you're not leveraging, your cash well. And I think that people, I don't know if they don't know about it or if they've forgotten, or it could be a combination, but I think that's one of the biggest things that I see.
That's a great point. And I think to your point, January is the big reminder because it's the beginning of the year, right? And usually, whether it's media or mail, et cetera, you're getting some sort of reminder about taxes. But as you get into the year, especially into the latter part of the year, not as much. So it can be somewhat easy for founders to forget about, taxes and preparing for the tax season throughout the year instead of just January. I love that. Now, what's your favorite tax saving tip? If you had to just think of one quick tip to give a founder with regard to tax savings tips, what would it be?
I'd say my favorite tip would be to leverage things like life insurance policies so that you have like tax-free wealth later on, and or like tax advantage accounts like your IRA, your Roth, self-directed IRA accounts, things like that. You have crypto accounts that you can leverage too, so that as you're investing, you're not paying the same amount of taxes you would if you just invested from like your personal bank account. So I'd say that's one of my favorite tools.
Wow, Patrice, and you just actually, I appreciate that advice and actually that point because you tapped on something that's a fairly new phenomena in the tax, preparation play, which is crypto. Any advice there, just as people are thinking about? I know crypto right now is a bit volatile, if you will, for those of you who are playing in the market. Bitcoin, I think today I looked up, was down to 91,000 after a high of about 107, 108,000 a couple of weeks ago, after President Trump-elect's announcement that he was going to be supporting crypto as part of his new administration. So any tips or advice on those founders who have crypto holdings and are now prepping for tax season?
Absolutely. So one thing I would definitely say is make sure that you are tracking every single transaction because they are visible. People can actually track the transactions. I know they said that you can't, track it on blockchain, but you can. And then another thing I'd absolutely say is that we talk about like capital gains when we're selling, and buying
Mhm.
those crypto currencies and some of the altcoins as well. You want to make sure that if you're going to hold it for at least 12 months so
Mm.
that you don't have short-term capital gains on any of the investments that you've made. So I would definitely say that as well.
And that's important advice because I think for those of us who haven't had an opportunity to invest in the traditional stock market, the
Mhm.
concept of capital gains and holding onto an investment to avoid capital gains is a tough concept to explain to people, right? And so I would encourage my audience because that is not this episode. We will be bringing Patrice back for multiple episodes and maybe one episode specifically on crypto, but I don't want to get derailed in this particular episode. But to say, do go out and do your research. I think
Mhm.
the point is
Mhm.
really valid. You do need to understand capital gains. Patrice mentioned something there that even if you have traditional stock holdings and you haven't quite understood or mastered that concept, it's definitely one to go out and quickly understand. So, Patrice, now continuing to move forward in rapid fire, I want to switch gears a little bit because I started off with some tax heavy questions, but you and I were just having a discussion before we jumped into the actual recording of the show. And I want to follow up on this in my rapid fire question. And that question is, if you weren't in finance, what career would you choose?
Oof, my goodness. You know what? I think I'd probably be a lawyer.
Wow. Now, wait a minute. What kind of lawyer? What kind of law would you be in finance?
Yes. So maybe securities law,
Oh,
or I'd be an actual litigator.
that would be I could see you definitely as a litigator. Now,
Mhm.
I would probably see you more in the vein of an Olivia Pope type litigator, where you was kind of
Yes.
behind the scenes, making people's financial, issues go away. That could
Mhm.
even be, I think, a pilot for an episode. We might need to develop that together offline, but I could definitely see you playing like the Olivia Pope of the corporate world instead of like the political world where they bring you in to solve for some sort of scandal. I bring you in because we just lost a ton of crypto and I can't figure out how to get the money back in the bank, right? So I got to call Patrice. That's a show. Hey, don't steal that idea. Whoever's listening out here, just reach out to Patrice. We're willing to give you a fee for that. Right. So last one on the personal question tip, and it's one that I, love to ask people who are in the finance space like yourself.
Mhm.
And this is something that I think over the years, especially with things like crypto now being kind of the hot new trend from an investment standpoint, people are, kind of all over it. But for you as a tax master strategist, if you could give one piece of advice to founders who are starting off the year in a deficit. So they ended last year with a loss, didn't have the year they wanted, are facing some pretty strong financial headwinds going into 2025. What would you advise them to think about or do?
Ooh, honestly, the first thing I would do is say revisit your pricing.
Mm, mhm,
I think a lot of
mhm.
times too, we forget as business owners that we don't have to work hourly. Like we need to really focus on leveraging all the experience, expertise, knowledge, licenses, certifications, training, all those things, and bundle that into the pricing that we're putting out to the market so that we're able to get the profit margins that we're looking for. We're able to keep that liquidity and that cash flow in the business. And so you're not experiencing those, like you said, those uh, kind of cash flow challenges or
Yeah.
financial headwinds.
Especially to start a year, right, where you really wanna be able to lay out a budget and figure out how you're gonna be able to spend and support things like advertising and promotions, etcetera, and so being in a cash poor position is a really challenging place to start. Look,
Mhm.
I love this. Let's get into the main part of the interview. So are you ready to jump into our Bland Blueprint founder interview focus on taxes?
I'm ready. Let's do it.
All right, great. All right, listen, as I explained before, Patrice is a master tax strategist. And so, what I want to do is two things. One, I want our audience to understand that you will be able to find and work with Patrice after the show. So, we will have her
Mhm.
information posted on the brandblueprint.biz. She will also be sharing her information at the end of this episode. So, you can reach out directly to her, as I am going to encourage you and those of you founders who are listening and need the help you definitely want to reach out and start your search for a new tax advisor with Patrice. So that being said, Patrice, let's start with the basics. Look, people are commonly, playing the classic, I'm gonna do my own taxes. I know how
Mhm.
to do it, or I got a cousin that does it. I'm gonna do some offline stuff. Like I find so many suggestions of bootleg ways to get your taxes done. But in general, what are the most common tax challenges you see founders face, especially those just starting their entrepreneurial journeys?
A lot of things. One, they're not even tracking their expenses and their income appropriately. So when it comes to tax season, they can't produce or generate accurate financials. So they don't have an idea of how much money they've actually left on the table because it didn't
Mhm.
account for everything appropriately. The second thing I would say is that even if they did account for things appropriately, they are not knowledgeable or they don't necessarily have a deep understanding of the tax laws, which is going to allow them to leverage all the loopholes, all the benefits of being a business owner to essentially either pay a reduced amount of tax or no tax at all. So I think
Mhm.
those are the two biggest things. So I do have a lot of amendments that I do when clients come to me of having to fix some things that
Right off the bat.
cousin or whoever else did. It's like, no.
And look, and I'll raise my hand as a former business owner, a current consultancy owner who also has a lot of area of improvement in the space. And I want to go back to that first area because I think you hit on something that I know for a fact I'm probably not doing the best job of. Most, I think, early founders make this mistake as well, which is number one, not getting a separate bank account to start your
Mhm.
business. Number two, not using any sort of accounting software, or and definitely not using a formal CPA or an accountant. So going back to that one problem, because it's such a common problem, give my audience some pieces of advice on how to get set up correctly, even when, because look, you're never gonna, it's never gonna be perfect. You're never gonna start a business perfectly. Like, oh, I've got this great idea and I'm just gonna start clean and create the account and create. But when they realize this is a business, okay, I'm actually now operating a business and I am taking money in, what should that founder do to start off the bat?
So, like you said, definitely getting that separate bank account, having that business bank account so we're not commingling our funds between the
Mhm.
personal and business. I think the second thing people should do is really like get a bookkeeper at a minimum, right? QuickBooks, they have QuickBooks Online experts that will support you for a fairly nominal fee to start with. So I think that something like that is very important. I think a lot of times
Mhm.
people use that as one of their last investments, that it should be one of the first, because
Mhm.
that's going to help you build that foundation for the appropriate, pricing structure, financials, all the things. So that I would recommend those for sure. Bank accounts and find someone that'll help you with your accounting.
Mhm. Mhm. So that's a good point, Patrice. And one of the things I wanted to kind of follow that up with a second question on is what are some strategies and some specific tools that founders can use to make sure they're getting that separation between, I know separate bank accounts, right, is one thing in using QuickBooks, but what I find is a lot of founders, especially founders who are working full-time jobs, they're like, look, I got one bank account, I track my expenses, I kind of know what I'm using for my business versus my personal. I really don't want to, start messing with my taxes because, I'm getting these deductions on my personal side, et cetera. What would you say to that?
So, a couple of things. First of all, business deductions and personal deductions are typically separate. So, we don't have to worry about that anyway. Two, even though we think that we're tracking everything like diligently, there's always going to be something that you forgot happened throughout the year, right? Because you have thousands of transactions that you have to
Mhm.
go through. So just do yourself a favor and open up that separate business bank account. You can track it. You can, have credit cards for your business, et cetera. And that way you don't have to worry about any challenges. Because if there's an IRS audit, they're going to go through everything. They're going to comb through transactions, bank account statements, credit card statements diligently as well. And you don't want that smoke if you don't have to have it. So just do yourself a favor and
Yep.
get the separate bank accounts. Additionally, with the business bank accounts, they typically give you business credit cards. So you want to start
Mhm.
building your business profile separately from your personal side anyway. So just do it.
Now, and that's a great point because I think you said something that in a personal finance sense, people would recoil at and go, she just said get some credit cards, right? Like somebody out there is like, man, I
Mm.
don't want no credit. Credit is gonna mess me up. Credit is what I don't need. Tell them why, Patrice, credit is a key part of the business strategy for a new founder.
So for a number of reasons. So first and foremost, the wealthy use credit and they use debt to build their businesses. debt is not taxable. So I just,
Mhm.
in case y'all didn't know that, debt is not taxable. So you're leveraging that as an asset to enhance your business. So if you're doing it that way, that's good. If you're responsible with your credit, that's an even better way to do it. And it's going to help you kind of expedite that growth of your business. So that's one of the
Mhm.
reasons too. Um, the second part about business credit is that they typically give you 5 to 10 times more credit on the business side than they do on the personal side anyway.
Wow.
So, yes. So typically, you go to American Express or, something else, a Capital One, and you open up a credit card on the personal side, they might give you 5, 10,000 to start. On the business side, they might give you $50 to $75,000 for your business because it's going to be something that's supposed to stimulate the economy.
What did she just say?
The second part about business credit is that they typically give you 5 to 10 times more credit on the business side than they do on the personal side anyway.
Wow.
So, yes. So typically, you go to American Express or, something else, a Capital One, and you open up a credit card on the personal side, they might give you 5, 10,000 to start. On the business side, they might give you $50 to $75,000 for your business because it's going to be something that's supposed to stimulate the economy. So you want, again, to make sure that if you have that option to leverage that to build your business and just be very mindful and responsible about making those repayments.
Now, just following that up, because to your point, you do get a multiple of credit on the business side,
Mhm.
but the key piece there, I think, to remind founders of, is because I hear founders sometimes reach out to me and say, "Hey, I applied for a business credit card, I didn't get anything," and then I immediately follow that up and say, "Well, what did you put on the application? Did you use your personal finances or your personal social security number?" Yeah, that's what I use. Okay, and that's why you didn't get it, right? And so
Yeah.
the one key thing I think to define right is the business account, and your business profile is based on your EIN number, not your social security number, right? So it's a key part of establishing your business identity early on. And it's one of those things, to your point, that founders make mistakes about, which is commingling those finances. That's why you get the separate bank account, so you can establish, this is my personal credit and my personal income bank, and this is my business
Mhm.
income and business credit, which are two separate things.
Absolutely. Can I just say one thing else
Yeah.
to take it a little bit further? So from the banking perspective, so when I worked at JP Morgan, right, like you'll see things come in, different, applications. And the thing that people don't realize is that if you don't have something like a business phone number, or you use a PO box, or like,
Mhm.
a FedEx or something like that, they're automatically going to discount you from
Mhm.
receiving that credit. So it's like you need to be very mindful about setting yourself up as a legitimate business entity before
Mhm.
you apply for that credit. So
I
just
love that.
a
I
pro
love
tip
that.
out there for y'all.
No, I love that pro tip, because I mean that is exactly the kind of tips that the new founder needs. Now, following along kind of that same thought process, tax deductions, right? Like the tax deductions can make or break a founder's tax strategy. What are
Mhm.
some deductions that founders might overlook? And I know, like, there's a couple of common ones out there that every founder's like, "Oh yeah, I'm definitely taking the office deduction. I'm definitely taking the company car deduction, or not the company car, but the car deduction, or the entertainment deductions." What are some deductions that people don't take and just don't think about?
So I would like to think that people do know about the business mileage and the repairs and all the things, but a lot of people don't know that.
Don't
They're
even
like,
know
"I can use
those.
that for
Yeah.
business?" I'm like, "Yeah." You better track every mile, you better track the gas, the repairs, any kind of like registration fees, licensing fees, all those things you need to track. But also something that I think is very widely overlooked is continuing education.
Mhm.
So if you're, reinvesting in yourself on the professional side, so like coaching programs, masterminds, those types of things people don't realize they can do.
And
Uniform.
those are deductible, right? Like the
Mhm.
money that you pay towards those. Even would
Absolutely.
that include like LinkedIn professional classes and courses
Yes.
and stuff like that as well?
Yes.
Wow. Okay.
Because
Okay.
if the point is to further your professional or
Yep.
business endeavors, yes, for sure. So even the LinkedIn, like Sales Navigator, or any of those types of
Yeah.
things. So, different software and applications that people don't know they can leverage. Um, you know, hiring people. So
Yeah.
if you're doing something like, I just lost the word, but when people, interning, you can,
Yeah.
if you're paying them, small or nominal fees, but you can still
Yep.
write those types of things. I mean, there's just a ton that you can write off that people just don't know.
Wow.
I actually have a checklist of like a whole bunch of different things that
That you
founders
can write off.
are
And
to be
so
mindful
let's
of.
talk about that, Patrice, because from a strategy standpoint, if I'm working with you, because I want my founders to understand the value the real value of what it's like to work with a tax strategist and a professional like you, because you're not just helping them with taxes. You're not just saying, hey, here's how to optimize your tax. Back to what we said at the beginning, you're helping them optimize taxes so they can build wealth, right?
Mhm.
And so take me, man, I mean, we could talk about this all day because I get so excited about helping people figure out ways not to just make money, but save money. And one of the things you just reminded me about that I think people forget is we get so reactionary when we approach taxes. We try to figure out ways now when we realize that we've incurred these taxes or these significant amounts of taxes. Then we're like, okay, how do I figure out a way to get out of these taxes, right? Or to reduce these taxes instead of being proactive and saying, okay, there are deductions available for me to go do continuing education, for instance. So now I can plan my calendar year because I know I want to take some additional courses or education that's going to help ultimately improve my business.
Mhm.
That is something you could plan to do versus getting at the end of the year, sitting down with somebody like Patrice, and she's saying to you, hey, you could have written that off, right? So
Yep.
talk a little bit about just from a strategist standpoint, what the real benefits are in engaging with somebody like you and how they should do it. Because I know and I suspect it shouldn't just be calling you up when I need to get my taxes done in January.
So yes, it is definitely proactive as opposed to reactive, or a situation where you've maybe received something from the IRS and you're trying to figure out how to fix it. So I definitely recommend working with a strategist because they can come up with a plan based on your particular financial situation and your goals
Yeah.
to help you achieve them throughout the year. Another thing I think is very important and impactful is that when we're talking about building wealth, founders and business owners typically forget that they need to position themselves for retirement at some point in
Right.
time.
Yes.
So, maximizing those IRAs, those Roths, those, 401ks, all of those different accounts, your FSA, like your spending accounts and your health savings accounts, like these are things that people don't realize they can leverage. And not only for medical expenses, you can use it for other things. There may be a little bit of a tax on it, but
But
there's a
still,
lot of way to build wealth strategically.
yeah. And Patrice, I've got to like double click on the retirement piece because as a
Mhm.
son of entrepreneurs who watched my father, frankly, as a lawyer for years ignore his retirement
Mhm.
considerations, right? He had worked as an independent contractor, essentially, as a lawyer for so many years. He had never really thought actively about how am I putting away for my retirement. Now, his wife, an electrician, for the last part of her career, her first part, she worked in a corporate environment for a power company, had a 401k, then took her 401k and invested it to start her business. Then that
Mhm.
business went forward without any sort of 401k attached to it.
Mhm.
Right, so both of my
Mhm.
parents eventually ended up in places where they didn't have any retirement savings because they had put the funding either in the business itself with kind of this thought process that I would either get to some, place where I could sell the business or finance from the business, and that would be what financed my retirement, and that didn't happen. So, I mean, retirement planning is so important. The first thing I wanted you to kind of dispel is this myth that you can't have a 401k or a retirement account as an independent entrepreneur or business owner. And then secondly, just talk to the audience about how I wouldn't say easy it is, but how seamless it can be to get your retirement set up. So it's not like because I think people think, my God, I don't have the $20,000 or $30,000 to put into in a retirement account every year. I'm not making that kind of money.
Mhm. Oh gosh. So first and foremost, we absolutely need to focus on retirement. One of the things we also talk about when we're doing tax planning is position your business for sustainable growth,
Yeah.
scale, and then sale,
Yeah.
profitable sale. So even if you don't have the thought of selling your business at any point in time, you still want to position your business in such a way so that your financials are ready if they need to be seen. You're able to get additional income, et cetera. So you always want to be thinking about how do I position myself for sale if it comes. Back to retirement, you don't have to put $20,000 into your retirement account initially. You can open it up with $100.
Yeah.
And if you're, putting money into it every month, that's still going to grow exponentially. Now, let me say this. You cannot save yourself to wealth. So if it's just a savings account, that's not going to help you. You're actually going to have to, in addition to putting money into that account, invest in something.
Invest in something.
So,
Yep.
Depending on your risk tolerance, you still want to focus on what you need to do. So if
Mhm.
things you love, if you like Starbucks, you like Nike, you like, I have AT&T, so I invest in AT&T. So it's things that like you actually use, but you want to make sure that you're doing something each and every month at a minimum, I would say,
I
that's
love
going
that.
to help take care of you in the future.
I love that. I love that. And I also think that the advice about, starting your business with the intention of making it scalable and profitable is
Mhm.
important, right? I think so many people jump in with the passion for the business idea, right? And they are in a lot of cases super motivated to get out there and deliver the service or deliver the product without paying really strong attention to profitability. Another thing my aunt struggled with her electrical business. She wanted to do right by people at times at a cost to her own profitability and
Mhm.
margin. And so she would go back at times 3 or 4 times over and replace light switches and replace breakers and things like that, that frankly weren't part of the service that she initially offered or weren't her responsibility because they were damaged or broken or whatever by somebody else, but she'd do it anyway. Right. And that profitability, unfortunately, would suffer because of it. So I think that is so great in terms of advice. Now, can you tell another kind of mystery? I think that when you're transferring from personal tax knowledge to business taxes, that a lot of business owners and founders don't understand is quarterly tax payments.
Mhm.
And I know it can be a little confusing in terms of when to pay, how to pay, et cetera. Can you break down how to approach quarterly taxes and what year-end tax planning should really look like?
So there's a couple different like schools of thought with this. If you are structured as an LLC, like a single member LLC, you're a sole proprietor, you're just, operating under your social security number
Mhm.
or doing business as, I don't necessarily recommend paying quarterly taxes, especially if you're not making a certain amount of money. So if you don't have at least like 50K left over at the end of the year, it doesn't make sense because
Mhm.
ultimately it's going to be based on your personal 1040
Mhm.
anyway, right?
Mhm.
If you are structured as an S corporation, a partnership, or a corporation, obviously you're expected to have payroll and
Mhm.
you're going to be paying quarterly taxes anyway because your
Mhm.
payroll provider should be sending it on your behalf.
Mhm.
So those are two things that I think people don't realize. So people who are LLCs or single member are on payroll when they really shouldn't be.
Yep.
And then people who should be on payroll are not on payroll.
Or
So it's like
not.
really identifying how you're structured, the actual income you have coming in, and then making sure that you are setting yourself up so that someone is actually facilitating that transfer of funds on your behalf.
That's such great advice, Patrice. Thank you for that because I mean that is for the audience. That's free game if there ever was free game that she just gave you right there because that's something that most people pay for in terms of advice, and that's real advice in the sense that there are so many people in the LLC structure that are doing things and executing things that are not supposed to be a part of the LLC, and one of them is
Mhm.
quarterly payments, and the other is payroll, right? And there are a ton of business models out there that are kind of stuck in this, hey, well, started with the LLC, that's what I started with, so that's what I'm doing, or vice versa. Somebody told me to start with an S corp or a C corp, I did it, and now I'm looking at it, and it's not the best structure for me tax wise.
Mhm.
What do you advise, Patrice, for people in those situations? Because I think I've been in both. Frankly, I've been in the LLC and needed to actually be in the C corp or S corp, and I started in a C corp at one point for a company because of the protection somebody described to me that I could gain from the C corp without even talking the tax implications or the revenue implications. So I just
Mhm.
started it, spent the money, had the C corp on paper, and then quickly realized it wasn't the structure I needed.
Oh my goodness. So I think you really need to be realistic about what you want your goals to be for the business first and foremost. So if you have desires of, having a large corporation, having employees, and then maybe potentially inviting shareholders to come in and invest in you, a C corp is the way you probably want to go. If
Mhm,
you're just going to have, employees, an S corporation, and if it's just going to be you, most likely an LLC is going to be fine. Now,
mhm,
when we talk about protection, an added piece of protection that you can do is to create an irrevocable living trust, or like what I like to call like the kind of business black box where you have it placed in there so someone from the outside can't come in and take
mhm.
the earnings of the business or
Yeah,
take your livelihood because something may have happened. So
yeah,
there are ways based on each level or structure, I should say, of your business that you can still protect yourself without
mhm.
having to put the cart before the horse, essentially.
I love that. I love that. And then if I'm a founder who's in one of those business structures now, and realize like, man, I need to actually improve my positioning. Would you advise that founder to reach out to a tax professional like yourself and then work on a strategy to transition to that new structure? Should they just, at the end of the tax year, shut the structure down and start a new one? What would be your advice?
Warning, the following information is important. You may want to pay attention.
Oops. Oh gosh. I think it really depends. So if it's a business that's profitable or you're going to continue working in it, you may just want to restructure it. And the
Mhm.
beautiful thing about that is like, if you needed me to, I could support you in the restructure of your entity. But the thing is, it's retroactive. So whenever the IRS does approve it, it's going to allow you to operate in that entity type or structure for that whole year. So for instance, if you were an LLC and you wanted to be an S corporation and we did it, and it ended up happening or being approved in March, you'd still be able to operate as that S corp, for all of 2025.
Okay.
Now, if you need to change from like a C corporation to just an LLC, you can do the
Yeah.
same thing.
Yeah.
And the guidelines or the parameters or the regulations, I should say, that is associated with that entity would apply to you for that whole year as well.
Wow.
But it is based on the approval of the IRS. So once you get that letter saying you are now, structured as XYZ, then
Then you can go.
yes. But in
Woo!
the
You are dropping
interim,
some game today, girl. Okay, let's keep going because this is crazy good. This is a lot of advice that I wish I would have known years ago when I started down this entrepreneurial journey. And you're really like just shedding a lot of light on things that I remember thinking like, oh yeah, this is the right way to do it. Completely wrong way to do it. Right. So now, on that same note, let's talk about some of the common errors that people make when filing for taxes. Because I know one of the key ones I wanted you to speak on, and I'm going to speak on it from a broad standpoint, even though somebody watching the show who knows me personally will probably reflect on a recent conversation. So whoever that particular entrepreneur or founder is, don't identify yourself. I'm not going to call you out on this, but one of the more common problems I've seen is the underreporting of income.
ooh, Lord.
So I want to start there because if there's one thing that I have seen and heard, and I'm going to even go a little farther and say, I've heard this in the streets before,
Uh,
that one of the best ways you can manage your taxes is by not reporting all of the income that you have bought in for that particular business. As a matter of fact, I've even heard it taken a step further to say the best way to keep the Uncle Sam out of your pocket is just report a loss every year. Just tell them you lost money every year, and that's the best way to do it. Talk a little bit about this underreporting income and messing with your income and the IRS, and what that really looks like.
mm. Well, first of all, we don't support going to jail. So I
Yeah,
never
exactly.
recommend underreporting your income. That's a great way to get an audit. And that's a
Yeah.
great way to get into even more trouble, not to
Mhm.
mention penalties and fines
Mhm.
and interest on top of all the things. So like, we don't want to do that. Um, And here's the thing, depending on how you run your business, if you're doing things like credit card processing, you'll get what's called a 1099K or whatever.
Yep.
And that goes to the IRS. So they see the amount of money that's come in. So
What you
it's like,
bought in, right?
we
Right.
know. And then also any of the other forms that come. So like people will be able to see what came into your business. So
And let's even take that step further because I think people hear that and go, oh, I don't use credit cards. Cash App,
mhm.
PayPal, all of your electronic forms of transfer payment include that 1099K, right?
Yes, and they're actually so they've been going back and forth about changing that. So it used to
Hmm.
be, $20,000 or 200
Hmm.
transactions, but then it was like $600. So it really just
Hmm.
depends. But regardless, a third party administrator is going to have to send that information so that they are
Hmm.
compliant with their tax obligations.
Hmm.
So
Hmm.
the fact that you didn't report it doesn't mean that somebody else did.
Correct. Correct. And
One.
because I've seen a lot of new businesses use this Cash App or think they're using a Cash App loophole, right? Like there's a
Mhm.
lot of that out here where I'll go to and I support a lot of entrepreneurs at pop-ups, at farmers markets, etc. And I've started to notice this trend as of late where there'll be a little sign at the thing that'll say, hey, we don't accept cards or anything, but you can Cash App us or you can just Cash App me. And I've asked before, like, why don't you accept Apple Pay and these other things? Oh, because the Cash App kind of helps me avoid, the whole tax thing. And I'm always at these booths like, no, it's not. But okay,
Mhm.
I'll go with what you think is going to help you out. But right, so the technology has definitely, I think, created a little bit more noise in the how do you track, cash and follow cash. Crypto is probably added to that. Do you have
Mhm.
any other thoughts around like just what people are doing with regard to using some of those different alternative methods of taking cash payments like Cash App and crypto, and how that still could come out in the wash?
Yeah. So listen, I understand like doing business like dirty, right? So just like getting up to make sure you're doing what you need to do to get the money. But the reality is, if you're wanting to operate as a legitimate business, if you're looking to be seen in the marketplace as a legitimate business, you need to have legitimate foundations in place.
Mhm.
Eloise, can you bring that back one more time? We need to hear that again.
Like the reality is, if you're wanting to operate as a legitimate business, if you're looking to be seen in the marketplace as a legitimate business, you need to have legitimate foundations in place.
Mhm. Mhm.
You can create a PayPal link.
Mhm.
Okay, you can still track that. So you want to just make sure that you are tracking every single transaction appropriately and just report it. Because if you have a good strategist or an accountant in your corner, they're going to help you offset that anyway. So like,
Yeah.
just do yourself a favor.
I
Come on
love
now.
that. I love that. I love that. Now, another area is common mistakes that I wanted you to comment on that I've seen, and I saw it with my parents as well. And I
Mhm.
actually have struggled with this too, which is just tracking all the documentation, the paperwork part of it. And I remember right growing up in a household in the 80s and the early 90s where it was literally paper. Like I can remember walking into my mom's office or my dad's office and being like, yo, like what the heck? Like can I help you? Like what? And they, oh, I got to keep all these receipts, son, because I got to be able to give them to my tax, person at the end of the year. Now we've come so far, Patrice. There's so many things out there to kind of help manage it. But can you just in general give some practical advice around like what do you need to actually like what do I need to keep paper wise? What don't I need to keep? Somebody was just telling me recently I still need to keep like certain paperwork and tax returns, paper versions of it 7 years or something after the first year was issued. Like what are some just general things to remember as a founder and like what do I need to keep and keep up with versus what I don't?
Ooh, so I guess that can vary, right? So
Yeah.
I will tell you that accountants do not want to have a shoebox of receipts. Like we don't want it. No, thank
You
you.
want
Right?
my
Like,
Jordan box with all my receipts in it?
no, thank you. With the technology today, like you said, you can do something as simple as if you get a receipt, take a picture of it on your camera so you can send that, to your tax preparer or strategist. You have QuickBooks Online. So if you have the app, you can
Yep.
upload a receipt as well. So they
Yep.
have the what is it called? OCR, like I
Mhm.
forget what it's called, something with the camera
Mhm.
where they take
And
it
so
and
many apps have it now, right?
yeah.
Like there's Evernote
Mhm.
and even I think now the Apple iPhone can do it just as part of the new intelligence feature. But to your point, you
Yeah.
can there's definitely tons. Now, let me ask you real quick. If you because I had this happen before. What
Mhm.
about expenses that you didn't know at the time were deductible and you didn't save the receipt, but you have like, it showed up on your credit card or on your bank
Mhm.
account statement, et cetera. Is that acceptable as a receipt?
Yes, I was gonna say that too. I was like, you can also reference your bank account statements and your
You
credit card
can.
statements as well,
Okay,
because
you can.
it's clearly a transaction that took place. So yes.
Now, what about cash transactions? I know they don't happen as much anymore, but for people who are spending cash or purporting to spend cash,
Mhm.
what what paperwork is it flat out a if you don't have a receipt, you just can't report that cash donation or that cash expenditure?
So you're not, I wouldn't recommend it, right? Like it's just best to
Yeah,
default on the side of like
some
having
sort
too
of
much
receipt.
information than not enough. If
Mhm.
we're doing things, when we talk about donations, so, Salvation Army, Goodwill, all of them will give you something, if you
Yep.
donate to
Yep.
them.
Yep.
You also have the ability to go online, and I had to do this too for client. You have the ability to go online, contact them, and ask them to generate something for you. So, regardless, you just need some sort of proof that you donated,
You're right.
XYZ
I've
amount of
do that
money.
before too. They will generate a
Mhm,
receipt for you, post a donation. At least
mhm,
the nonprofits typically will. So I think that's
absolutely.
great advice. Now, on that same note, in terms of additional mistakes or just bad advice out there, in terms of filing for taxes, et cetera, let's talk about extensions. When should you use it? Why should you use it?
Mm. Listen, I love an extension. If if there's a situation where maybe like you have a lot happening, you have to have some changes in your bookkeeping, you just
Mhm.
are not going to make the deadline, or it's just like a lot of different extenuating circumstances. Now, the caveat with an extension is if you think that you're going to owe, just understand that the interest, the penalties are going to be assigned to you because you
Here you
didn't
go.
make that April
Yep.
deadline.
Yep.
They're giving you an extra 6 months. And if you wait the whole 6 months, that interest is going to be tacked onto it. So
Yeah.
just understand that. If you don't know and you file your extension, then I mean, it's like whatever. Like you just got free time, to get everything in, because sometimes you don't have all the paperwork, you can't, locate it. Oh, another note. People don't know that you can go to the IRS website and request a transcript to get prior tax returns, W-2s, all the things if you can't locate them physically or you haven't received them from the person that's supposed to send them to you. So those are
That
reasons why
is a good
sometimes you need
tip.
extensions. But yeah, I highly recommend, if you don't have to, then just file it during the regular tax season deadline. If you need to, go for it. But if you owe, just understand that there's going to be some additional monies paid out because of the extension.
Wow. Okay. No, that I love that one. And now transitioning from mistakes, one other common mistakes, one other area I wanted you to speak on was respect specifically to founders. And this one's a little difficult. And this one I'm going to say to founders before we get into too much detail with Patrice. You will need to reach out to a tax professional like Patrice to navigate this area specifically, because I know a lot of founders struggle with it. And that is the intake of investment / angel investments or friends and family money. And then secondarily, whether you're doing it before you actually take money from people or you're doing it after, the whole prospect of valuations. And I bring that up to say, I meet with clients weekly in the startup space who will tell me, hey, I've either already raised funding or I am raising funding. And one of my first questions is, okay, great. What is your valuation? How did you come to the valuation? And the answer I get, or answers, are so all over the place. And I know it's not right? And I know small business and founders that are starting out don't always have the right resources of funding to go out and get a true valuation. But I also see, especially with the advent of Shark Tank and so many other TV shows, that people understand in general investment is a possibility within my personal network. So there are plenty of founders and taking money from friends and family and angel investors and not quite providing those investors with, number one, just a clear, transparent understanding of what the valuation is that investment is being made on. But then two, any sort of paperwork or structure around, a safe note or anything to just say, hey, you gave me X, and so I owe you Y. So without going into extra detail, because again, my audience, you need to understand valuation work, fundraising work is real work that requires a professional partner. That's not something I advise any of my clients to try to do on their own. But Patrice, just a general, talk a little bit about that process of taking money and funding, especially as it relates to taxes, because I know there are examples of people who have taken significant money in the form of investments in a given calendar year and not thought anything about the implications to taxes on that.
Yeah. So there are a number of ways to get money, right? And it can be considered earned income. So you definitely do want to make sure that you are tracking that diligently. As far as what you're going to get as a result of investing in a company, you also want to track that very meticulously. And you want to work with a lawyer to help you determine if it's going to be, equity in the company that they're going to get in return, if it's going to be a repayment on a loan or a note, at some point, and maybe it's like a balloon payment at the end of the period. So you really just need to really focus on what those repayment terms are going to be and document that very clearly when things are working well, because, right, when things start to get funny and people want their money back, it can get really nasty. So you want to make sure that those things are ironclad in black and white, and there's no room for any kind of like question about what the expectations are. So I definitely say that. I think that before you take money, you really need to be like mindful about what you're going to do with the money as well, because we don't want any situations of like conversion, right? Taking money from one thing and then doing something else with it, because that becomes a problem as well. And that could be, a legal challenge for you. So it's just like,
and can you expand on that? Like, because I think people might have missed that. Taking money for one purpose and using it for something completely different than the purpose you stated it for is actually a legal issue. It's not simply the prerogative of the owner. And I've heard some founders and owners say that before. Oh, I know they gave me $50,000 or $20,000 for to support my marketing and promo, but I had to hire somebody, or I had to pay myself. Now that's a common one I've heard at times, right? Even though I took this funding in and I told them it was to grow the business, I actually have $50,000 or $75,000 in debt, or I've got this credit card I've got to pay off, or I've got
Mhm.
this other investor that I owe that wants out. And so I'm using this funding to just get this person out. Talk about what the implications of decisions like that can actually lead to.
Ooh, definitely legal implications. So like we said, it's
Mhm,
called conversion. So if
mhm,
you you want to make sure that if you're taking money that you're using it for the actual agreed upon use, right?
right.
You don't want to do anything else with it unless you have a conversation and you amend any of the documentation that has been created. So be very careful about how you use that money. Um, and two, if it gets to a situation where lawyers are involved, then that's like a whole different set of challenges, right? So you have to pay for the lawyers, you have to pay for litigation and,
Right.
you know, or mediation if you decide that you want to settle out of court. But it's just like, why even put yourself in that position if you don't have to? Just
Exactly.
do what you say you're going to do and just keep it square, right?
And
Because you
document
want
it.
to make sure that, yeah, that people trust you as a person and as a brand. You don't want that tarnished either moving forward. So,
Yeah. Yeah. And would you say valuation at what point in a brand's or a company's existence is a valuation important?
so a couple, I would say a couple instances. If you're planning on actually selling or you want to start to get investors to come in and support you with the growth of your business, and that's
You
going to
need
be a really good
valuation.
time for you to have valuation. You
Mhm.
want to make sure that you work with somebody who does like mergers and acquisitions or who really focuses on business valuation and getting the sale of the business or having
Mhm.
people buy into you as well, because
Mhm.
they know all the ins and outs and intricacies of the law and how to negotiate that. So, you know, people don't just wake up one day and say they're going to be doctors or lawyers or accountants or, you know, consultants or all the things. It's a period of time and education and life experience and trial and
Mhm.
error and
Mhm.
right. So it's like, don't decide that you want to do these things because you're a founder now and all of a sudden you think that you're going to evaluate your business at a certain, you know, level. In addition to that, if you don't have your financials in order, you can't create a legitimate valuation anyway.
There
So
we go.
like
And
you
the
just
and the financials in order meaning what? What are kind of the key components that you would need for evaluation?
so a handful of things. You definitely need to make sure that you can generate a profit and loss statement, a balance sheet, a statement of cash flows. When people think about valuation, it's are you familiar with EBITDA? Equity
Mhm.
before interest, you know,
Mhm.
taxes, depreciation, amortization. You need to make sure that you have at least $1 million in EBITDA before you start to think about selling or having a valuation done, because that's when you can start to identify what your multiple is if you sell.
Whoa. We need to hear that one more time.
So a handful of things. You definitely need to make sure that you can generate a profit and loss statement, a balance sheet, a statement of cash flows. When people think about valuation, it's are you familiar with EBITDA? Equity
Mhm.
before interest, you know,
Mhm.
taxes, depreciation, amortization. You need to make sure that you have at least $1 million in EBITDA before you start to think about selling or having a valuation done, because that's when you can start to identify what your multiple is if you sell. So I have $1 million. I could potentially sell at a multiple of 5x. So I can sell for $5 million or 50 million. So you have to have these things in order that's going to show the strength and the health of your business that will actually generate that valuation that you're presenting to your investors. You
Now,
can't
hey,
just make stuff
Patrice,
up.
in the spirit of this show, we have rewind moments. This will actually be one of our great rewind moments, is the breakdown of EBITDA and the $1 million level, because it's such a missed point in the conversation around founders and startups. When do you evaluate and at what financial level? And I'm meeting founders that are pre-revenue that
Mhm.
have valuations, right? Like literally founders out here pre-revenue, like, yo, I got a $5 million. And I know the reason why this is happening. And I don't blame Shark Tank because it's one of my favorite shows. But Shark Tank has, in a way, miscommunicated how valuations really work in the real
Mhm.
world, because
Mhm.
every brand and business you've ever seen on Shark Tank has a valuation, right? And many of them that you see on Shark Tank have not hit $1 million EBITDA. They just haven't, right? And so for my audience that's watching, and maybe kind of a little bit confused about what Patrice and I are talking about, I think in general you need to think of it this way. If you don't fully understand EBITDA, look it up. But even if you don't understand it, just understand that your business needs to at least achieve a minimal level of sales and profitability before
Mhm.
you start going down the valuation path. Now, you can use industry standards, right? Because every industry has kind of an industry standard for evaluation. Like in the beauty and cosmetics industry, it might be 3x revenue. In the tech industry, it might be 5x revenue. So it's good for you to know what your industry guidelines are for valuations. And if you want to use that in the early stages to say, hey, I've made $350,000, on an annual basis so far. If I just used industry standards, that would roughly be $1 million valuation based on the 3x multiple. That doesn't necessarily make your valuation legitimate, but it does at least give anybody who you might be talking to about investment, angel investment, pre-seed investment, somebody or something to go off of. So I really appreciate you going into that, because I get that a lot. I get a lot of questions around, hey, where do I go get a valuation? Right? Like people just say, hey, can I go to somebody and get a really quick valuation? And I think one of the things that you brought up that I'll kind of remind our audience what you advised in early the call, which is your documentation and using the right systems to manage your finances. So having that QuickBooks in place, like Patrice said at the beginning, is going to then give you the P&L, the balance sheet, and all of the supporting paperwork that not just investors are going to ask for, but also banks, right? Like I think some of our founders, those of you thinking about line of credits, loans, you're going to need the same paperwork from your financials in order to achieve it. And you can't go after the fact and say, hey, take my personal bank account and create a balance sheet and a P&L. It doesn't work like that, guys. So I really, really appreciate the advice, Patrice. Now, look, before we wrap up, what advice would you give to founders as they prepare for tax season this year?
Oh gosh. Have your records, like get everything in order. If you don't know how to do bookkeeping, do not do bookkeeping. Have somebody support you in that effort. If you don't understand everything that you need to have, I'm happy to support you with a checklist of things to gather in preparation for tax season. If I could just say one more thing about the whole valuation, I think a lot of people too don't understand that it's not just like the overall income that comes in, right? It's people, processes, and it's also IP, right? Like intellectual property. Like these people take all of these types of things into account when they're doing valuations. And so it's not just like the revenue that you came or that you received based on sales. So just be mindful.
I love that. That's a great point, because you're right, the IP, and we hadn't even touched on, the IP concept and where it fits in that valuation play, especially as the tech industry continues to explode in terms of founding companies. The IP piece is a really big portion of your valuation. So, man, Patrice, your knowledge is just crazy. I mean, like I said, we could go every which way, every direction. Now, on that last piece of advice, I wanted to follow up with one more thing, because again, audience know that you'll see Patrice again in successive months, but we're going to be out of tax season, and we're going to be talking about other things that relate to finances and founders, especially as it relates to growing your wealth, right? Like I love to, tap in on taxes, but I really want to get to the wealth growth. I mean, that's really what I'm about. What I'm here for is the young folks saying, I'm trying to get to the bag, Patrice. So at the end, we want to get to that advice as well. But as we wrap up this tax episode, last thing I wanted to have you kind of address is this, kind of conversation out there / category of software, related solutions for tax services, because people get bombarded. It's January, right? And they're getting all the emails and all the hits for, tax advice. And, oh, you can get this particular piece of software, do it yourself, maybe on personal taxes. But can you just address, kind of why working with a professional like yourself for business taxes is an important thing in consideration versus using, software or some other self-guided process?
Absolutely, for a couple of reasons. So as somebody who does the actual like preparation of like corporate taxes, partnerships, estates, and trusts, all those things, we have access to software that you wouldn't have access to, first of all. So you wouldn't even know what you didn't know that you didn't apply to your tax return. Secondly, there is a lot more compliance. There are a lot more forms associated with those different corporate returns. So you need to make sure that you understand how to complete them first and foremost, and then make sure that you are transmitting them appropriately into the right agencies. So I would definitely say just work with somebody. Take the shortcut, y'all. Just take the shortcut. Let somebody do it for you that does it, and that's what they do.
And that's what Patrice does. So we are going to make sure we make Patrice's information available. But right now, look,
Mhm.
your insights have been incredibly helpful. And again, I can't wait for our next episode, our next opportunity to talk again. But before we go, can you let our listeners know where they can find more about your services?
Oh, absolutely. So you can find me online at www.unapologeticaffluence.com. You can also find me on LinkedIn at Patrice J. Malloy, Facebook at Patrice J. Malloy, and Instagram at I am Patrice Malloy. So you can find me and all those, and YouTube. YouTube.
And YouTube. So make sure you look out for Patrice on all of
Mhm.
those platforms. Again, we will have links on our website as well as our social media pages, not just tied to this episode. As I mentioned, Patrice and I will be doing content on an ongoing basis. You will be able to find me on her platform, her on my platform. So again, more value, more opportunity for founders, for startups, and for business owners to really leverage all of the great content and all of the great advice and tips that we offer here on the Brand Blueprint.
Yes.
All right. So listen, guys, I would really, really appreciate if you go out, share the show, find people who are in need of tax advice, send it over to them. And as always, like our information, as Bomani Jones says, if you don't like us, I tend to think you might be a hater. So don't be a hater. Go out and like our content, share it with friends and family and other business associates who could benefit from it, especially this episode, because this is just full of great advice from Patrice today. So make sure you subscribe. Don't miss the next installment of Finance for Founders via Patrice Malloy and our famous and now or soon to become famous platform with partnership with Unapologetic Affluence. So we're looking to continue to partner and bring you great content. But until then, thank you for tuning in, and we will see you the next time on the Brand Blueprint.
Bye.
Thanks for joining us on the Brand Blueprint journey. Make sure to follow us on all of our social media platforms to stay updated. Watch the full episodes on our YouTube channel for an in-depth experience. Don't forget to subscribe to our website at thebrandblueprint.biz for exclusive content and materials. We're everywhere you need us to be.